we are going to try to work some problems kind of like your homework. And these problems are going to help us to start to understand about T accounts and trial balances and everything in between. All right, so the first problem is these problems are the static versions of the textbook problems. These are the A versions and your homeworks will be the B versions. But you can look at them in the textbook if that helps to clear it up, or you can just look at it on the screen with me because it's the same problem. Okay, so this says post and balance the T accounts. And they've got some entries in the T account already. This is a cash account. It's got 3 debit entries. It's got 2 credit entries. So this is just helping us learn how to tally up the ending balance on the account. And so what we've got is cash had a debit of 500 and another one of 400 and another one of 600. So I'm just going to add those together. What is that? $1,500. I'm just going to put that as a subtotal here. Then the credits, it has a credit of 100 and a credit of 200. So that's 300 credits. Oh, look, put it on the right place. 300 credits. So the net balance of this account should be $1,200, right? So assuming I did it right, it's good. But instead of just clicking on, you know what I'm going to do. I'm going to check my work and see if I got a problem here. Hey, it's beautiful. No problem. So then I go to the next one. This says debit and credit analysis. Complete the following statements using either debit or credit. So the cash account is increased with and here's my recommendation. You can see all this. I think the thing to do would be to pause my video when you get to each problem, try to work it yourself, and then let me talk you through it afterwards and see if you got it right. That would really help you to be stronger if you did that. Okay, so that's just, I really think that's the best way to handle every one of these exercise videos. All right, so the cash account is increased with a debit because all assets are, right? And the owner's capital account, which is a equity account, right, is increased with a credit. Then the delivery equipment account, an asset, is increased with a debit. The cash account, an asset, is decreased with, oh, wait, it didn't say increased. So if it asked me if it was increased, I would say debit, wouldn't I? But since it said decreased, I have to go the opposite. So remember, I told you how we're going to focus on the increase side. The increase for a cash account is a debit. That means I'll know. If I know what the increase side is, I'll know when they say it decreased, it's going to be the opposite. Okay, so they gave me my first challenge, a decrease. And then number E, the liability account, accounts payable. Hey, that was nice. They told us it was a liability account, is increased with a credit. The revenue account, delivery fees, is increased with a credit too, isn't it? The only ones that are increased with a debit are assets, drawings, and expenses. Okay, the asset account, accounts receivable, is increased with a debit. The rent expense account, okay, now only ones that are increased with a debit are assets, drawing, expenses. Oh, it's an expense, so that's how I know it's going to increase with a debit. And then the owner's drawing, here it goes again, assets, drawing, expenses, increases with a debit. And then I look back at one more time and say, okay, I make sure that if they all said increase, then I would have said one thing, but if something said decrease, I got to make sure it's the opposite. Only one said decrease, and that's that one we caught. All right, so I think I'm ready to check more. Yay. Okay, then I go to the next one. This is number 3, problem 3.3 or exercise 3.3. Richard Gibbs began a business called Richard Shoe Repair. Complete the T accounts for cash, supplies, Richard Gibbs capital, and utility expense. Excuse me. And it wants us to take these transactions and post them to those different T accounts. So it wants us to use the A, B, C to identify them. Okay, so the first thing that happened was, this is the first transaction, A, invested cash in the business, $6,500. If you invested cash in a business, that means cash increased. So this is transaction A. We're going to put it as an increase to cash, which of course is a debit. We know that. This other part of the transaction would be invested cash in the business. Okay, that's going to be a capital contribution. So that same $6,500 needs to be credited to the capital account, and we'll mark A. So now we've got both sides of the transaction recorded, a debit entry and a credit entry. So that's great, right? We know we have to have a debit entry and a credit entry for every transaction. So B, purchase supplies for cash. Now, when it says purchase something, it means we bought it. So we bought some supplies. So my feeling is you should always do the part you're most comfortable with about the transaction first. So if I know supplies is an increase of an asset, and so it should be debited for 700. If I know that really strong, I might put that first. But usually I take the impact on cash first and enter that first, because I usually most comfortable with that I know what happened to cash. So in this case, we purchased supplies for cash. If it says you purchased something with cash, it means your cash decreased, isn't it? So cash increases with a debit. That means if you're decreasing cash, you're crediting it. So $700, that's transaction B. So, and then the other side of it was purchasing the supplies for $700 for transaction B. So now I should have mentioned earlier when I was talking in the lecture about this, but I'll just mention it now. The, excuse me. Let's see, where was I going with it? Supply, the word supplies, a lot of people think of as an expense, but supplies is talking about the supplies that are in the inventory, like the cabinet, the supplies cabinet or the supplies warehouse. So it's not talking about the supplies that you used up. If it says just the word supplies, it's talking about the asset supplies. And also whenever you use the term debit and credit, it's opposite of what the bank statement would say, because the bank likes to say things the way they're from their own perspective rather than the business's perspective. And so when you can't let what the bank calls it affect how you record it. So because whenever you have, the bank uses the exact opposite. So we're not trying to say, well, the bank would say this was a debit or a credit and then reverse it. No, we're just learning that debits and credits are a certain way, and we're keeping it totally separate from the way the bank would handle it, because they are talking about their own perspective, not the company's. Okay, so that was transaction B. Transaction C, now we paid the utility bill. Again, you paid something. That means your cash is decreased, and it's $700. No, it's not. $2,700, sorry. And that's transaction C. And we're going to debit utility expense for that same $2,700. And put a C by that one. Okay. Now, the only thing else we have to do is when you're tallying a T account, if there's only one transaction that happened to that T account, you don't have to do anything to tally it because it's already there. If there's only a credit of $6,500, like for this capital account, that's all you have to enter. If there's only utility expense, one entry of a debit of $2,700, you don't need to draw a line and make a summary total that says $2,700 again. It wouldn't hurt, but it's not needed. So, but if you have an account that has multiple transactions on one side, most people like to subtotal what happened on that side. So in this one, we have a subtotal here on the cash account on the credits, because that's, so that'd be 3,400. Is it? Oh, I need to be able to enter it properly. There you go. And then there's only one entry on the left side, so you don't have to put 6,500 down again. What you need to do though is say, what is the ending balance of cash? If you had an account, any account that has debit entries and credit account entries, credit entries, you have to net them out to see what's the ending balance. We're expecting this to be a debit balance because it's cash, and the normal balance for cash, because it's an asset, is a debit. So what we've got is debits of 6,500 and credits of 3,400. Well, debits are bigger, so obviously the ending balance is going to be a debit balance. We take 6,500 and subtract the credits that were made against it. And we say 6,500 minus 3,400 means 3,100, right? Okay, so basically what happens is you had 6,500 in your account, the debit balance, and then every time one of those credits came in and was posted, it ate up some of your debit balance. And so your debit balance was getting smaller, smaller every time a credit was posted beside it. So that's the way it works in all the accounts. That's why you take the total and subtract the total and take the smallest number as a subtraction from the larger balance. Because the contra of a debit account is a credit. and it's eating up part of your debit every time you make a credit to the account. Same thing, if it happened to be on the other side where you had a credit balance account and you made a debit to it, it would eat up part of your credit balance. This one just only happens to have a debit balance account that's being impacted by multiple transactions. Okay, so I think I have it all recorded. Let me give it a shot, see what happens. Check marks, yes, yes. I don't want any of those little X marks that are nasty grams, right? Okay, all right, so the next one is exercise 4A. Normal balances of these accounts. It's the same thing as asking how to post an increase. So cash account increases with a debit. That means it's normal debit. Wages increase with a debit. Accounts payable is a liability. So it's going to increase with a credit. That's its normal balance. Then you got owner's drawing. The owner's drawing is a negative or a reduction in the capital, remember? So it's a debit. The supplies account's an asset account. So it's a debit. Owner's capital is the equity account itself. And so that's a credit balance account. And equipment is an asset. It's a debit balance account. So before I click it, I got to look and make sure I have got it right. So assets, drawing, and expenses all should increase with a debit, which means they have a normal debit balance. And so let's see what we got. Yes, that's good. Yeah. Cash and wage expense, both debits. Accounts payable credit, owner's drawing debit. Accounts payable credit, owner's drawing debit, supplies debit, equity credit, and equipment debit. So I should be right. Let's see. Yay, we got it. Okay. Now, this one just has a few more transactions, but it's the same exact thing. We're just learning and getting some experience with how to record these transactions. So we're doing the same thing. Invested cash in the business, $5,000. That's transaction A. Cash increased, and so did capital. The second thing, we bought equipment for cash. Cash decreased by $700, and equipment increased by $700. And then the C transaction, we bought equipment on account. That means we increased equipment again. How much? $600. But we didn't pay cash for it this time, so we're not going to put the credit $600 up here on cash. We're going to put it on accounts payable. Transaction C. Then transaction D, we pay cash on account for equipment that we purchased in transaction C for $400. Okay, so we pay cash on account for equipment. Does that mean we should record equipment again? No, because we're just paying the balance of something we owed. They just mentioned the purchase of the equipment to remind us that we already recorded it. And so we paid cash, so our cash went out, $400. That's the part I'm most comfortable knowing what to do with. Every time I pay cash, I know that's a credit. So I've got a debit that I'm going to make to one account. And what account is it? Accounts payable. And it's $400. D. And then the E transaction, withdrew cash for personal use, $900. Withdrawing cash is taking money out of the bank account for the owners, isn't it? And so drawing is our last entry. We want to E. How much was it again? 900 and E. Except for I can't see it, so I'm just going to scroll down. There it is. Okay, so I'm not going to paste back through it. You could double check it, or I'm just going to check my work. See. Yes, all check marks. So, hey, we're good. We recorded all the transactions. Then this one has already got our transactions posted that we just did. Actually, I think it's the same ones we just did too. And it says, Lisa started the business on May 1st of this year. And these are the transactions for the first month that are already in the T accounts. It's telling you what they did each transaction. And so then they want us to put the T accounts. Do we need to know what these transactions are in order to do it? No, we already have it in we already have them posted to the T account. So the only thing required, once you have them posted, it's not go back to the transactions, but just tally up what you already posted. So there's only one entry to the debit side of cash, so we don't have to subtotal it. We need a subtotal for the credits though, because there were 3 entries over here. 700 plus 400 plus 900 is, let's see, 1,100 plus 900, $2,000, right? So $2,000 credit, and that $2,000 is eating up part of our $5,000 balance, leaving us with just a $3,000 balance, right? Then for the equipment, we have 2 entries to equipment on the debit side. If you have 2 entries to the same side, it just makes a bigger debit. So 1,300 is our debit ending balance. Then the accounts payable account, it has a debit entry of 400 and a credit entry of 600. It's 600 is bigger, so that 600 is ruling us. And so that's our balance. And 400 has been eaten up by a reduction, the debit. So we owed 600, and that's why we had a credit to accounts payable. And so then once we have that debit show up, it decreases the amount that we owe. So only thing we owe now is 200 because the debit ate up some of the credit balance. So the only thing left is a $200 balance. Nothing needs to be tallied on the capital account or the drawing because they only had 1 entry each. So I think we've got what we need. Let's see what happens. Check marks everywhere. We're good. One more piece. We're going to take that information we just did, those T accounts for the same account, and make a trial balance. That's what they did. See that? These trial balance accounts are just based, well, this might be a different company. Yeah, okay, never mind. It's not the same one, but it could have been the same one just as easily. It's just this one has more transactions, I think. So we could go through the whole thing where we record every transaction and then we pull the balances for them and then we make financial statements. But what they've done is given us this scenario for this home repair company, and they gave us their trial balance, plus they told us what happened to their equity. And they didn't have to tell us that their net income was this because we were about to calculate it. And they didn't have to tell us what their drawing was because it's right here in their trial balance, right? But they did tell us those things. But we hadn't, and the original investment in the business was $35,000. That's showing up right here also as capital. And they didn't have any other increases to capital other than that original amount he put in. Okay, so that's that part they've given us, and we're going to go through and do the 3 statements. They always have to be in the same order. It has to start with the income statement because we need the income, the bottom line net income, to be able to carry to our equity statement. Then on our equity statement, we're going to calculate everything that happened that affect equity by taking the beginning equity, adding in any increases plus the net income, and minus drawings. And that's going to bring us to the ending equity or capital. And we're going to use that ending equity and capital as the number in our owner's equity section of the balance sheet. So we're just going to roll through that from our financial statement. We're going to roll through these financial statements from our trial balance. So the first thing we did is we're going to have on the income statement, we need a heading that says revenue. And then we're going to need a heading that says expenses. And so there's only one revenue account in this group, and you see it there, service fees right here. Well, let me just pick service fees, but that's okay. I won't pick all these incomes and revenue and expense accounts actually. Service fees is $15,500. Turn to the page where I've got all my lists, so I don't have to flip back and forth so much. The expense names, I'm just looking at the schedule for that because I don't need it actually to see what to do, because all you do is pull the expenses that are listed right here and the amount that they have for them. So since I don't want to flip back and forth, I'm just going to look on my paper while I enter that. Rent expense is the first one, and the amount for that is $850. The next one is wage expense, and the amount is $800. The next one is phone expense, and the amount is $230. And the last expense is gas and oil, and the amount is $155. Now, just glance at those: rent, wage, phone, gas, and I'm just verifying with you. They're the same ones that are listed right here in the trial balance. That's all I'm doing. Your textbook shows it. So you could hold your textbook beside it as you're keying in it. It would probably help you. Like on your homework, it's the B version on the textbook. And so you could do that too. So you don't have to flip back and forth. Okay. So the total, they want us to give the total expense, and all we're going to do is add up those 4 expenses. And I think the total is going to be $2,035. So then we can take our total revenue minus our total expenses, and that'll bring us to a net income. If it had been that the expenses were higher than the revenue, we would have a net loss. But since the revenue is higher, we've got a net income. 15,500 minus 2,035 means our net income is 13,465. 13,465. Okay. Everybody's cool so far? If you're nervous at all, let's do check my work. So far, it's beautiful. If you're building this from scratch, you need to make sure you have the company name, the word income statement, and then the period of time, not the last day of the month, but the period. In other words, for the month ended or for the year ended with the date that it ends. Okay, so now I've got my net income number. That's what I'm going to need when I get down to this equity statement. This equity statement starts with his beginning balance, which this is his first year, so he didn't have one. The amount he contributed, and so we know how much he contributed because it shows the 25,000 in that note they gave us. The extra details when they told us what happened in his equity account right here. That's this 25,000 right here. Okay, so that's what we just added. So now we know his total investment is 25,000. So from that, we take that as the beginning place of here's how much the equity is before we start talking about net income and drawings. We add the net income. The net income for May, we just calculated 13,465. We got it on our income statement. Then the drawings, we're going to reduce by the amount of the drawings, also known as withdrawals. Drawings and withdrawals, the same thing. Let's go back up here and see, you'll see that they told us in their little information how much they were, but they also were right here in the trial balance, $2,900. So we're going to just put that there. So the total, the next subtotal we want is the increase in capital. How did it increase or did it decrease? Well, look, it increased by 25,000 plus 13,465 minus 2,900. So that's definitely an increase. If you tally that up, 25,000 plus 13,465 for the net income minus the drawings of 2,900, you're going to get 10,565 for the amount it increased. Oh, I'm sorry. That's not what they did. That's if you took all 3 of those I just said, you're going to get the total equity for the whole year, 35,565. So the subtotal they wanted, the increase in capital, wasn't talking about the part he had invested to. It's talking about the increase from the net income and the withdrawals. Sorry about that. So the 13,465 minus the 2,900 is where you're going to get this increase in capital. Okay, and then the end result is his capital account at the end of the month. So I don't know how many check my works I have on this available, but I guess I'll check and see. That one's good. All check marks. Again, statement of owner's equity would have the company name, then the word statement of owner's equity, then the period of time for the month of, or if it's a week, for the week of. If it's a year, for the year of May 31st or December 31st of 2021, whatever period it's ending. Then from there, we take this equity amount, 35,565, and we drop it in right here, 35,565 into our balance sheet as his equity, his capital. All right, the other things we need is a balance sheet, is a list, is all the assets and all the liabilities and equity. That's why it's called a balance sheet. It's the accounting equation in summary on a report. So all the assets will be listed, and then the total that is all the assets would equal exactly the same amount as the total that is all the liabilities and equity. But I mean, we haven't done it yet to double check, but we're going to come out right, I bet you. All right, so the asset accounts, looking in the trial balance, is all this top section: cash, accounts receivable, office supplies, prepaids, equipment, and van, and each of these ending balances. You wouldn't go back to the T accounts and look at them again. You wouldn't go back to the transactions and look at them again. You only look at the trial balance, and that's how you make all these financial statements. All right, so since I don't have to look back and forth, I'm going to do it from my paper. Cash was first at $21,805. And again, these are coming straight from the trial balance. Accounts receivable is next at $2,700. Then office supplies, you're putting them in the same order they were in the trial balance, $160. And then prepaid insurance, $1,100. And then equipment, $8,200. And then van, $6,000. So for a total, if you add all those assets together, $39,965. So then we're just going to hold our breath until we get the total on the liability and equity side, right? Because we want it to be the same. We got to go back up to our trial balance and get the liabilities. It's always listed in the order of the assets first, which was all of these, then the liabilities, and then the equity. The only one I see this liabilities is accounts payable. $4,400 for accounts payable. Okay, now let's add up the total of the liabilities, $4,400, and the total of the equity, $35,565, and we're going to get a total of $39,965. We look over at the assets, we see it's the same. We're like, yes. So we're so happy. So let's check my work one more time. I was just picking this with my finger. I picked the wrong account. Down here when I was trying to pick van, I got service fees accidentally. Hey, this is why you want to use check my work, right? That's right. Now it's perfect. It's ready to submit. And the other thing to notice about this one, the balance sheet has the company name, the word balance sheet under that, and then the date as of the last day of the month. It doesn't say for the month of, for the week of, for the year of. It says just that date, because remember, the balance sheet is as of a point in time, not a period of time. Okay, so then I think we've done them all. We're so happy. It looks like it works. We submit. It says, are you sure? Yes, I'm sure. And then it gives me my score, 100%, and I congratulate myself, and I say, yes. Whew. Okay, thanks, guys. Did good.